All right, welcome back to Yahoo Finance Live on this Monday morning. A busy week here in markets. Got all the FANG names out with their results later this week, but it's also a busy week for economic data. GDP numbers will come out. We also have a Fed meeting set to take place on Tuesday and Wednesday. Joining us now to talk about everything going on in the economy this week is Joe Brusuelas. He's the chief economist over at RSM. Joe, thanks for jumping on this morning. Let's start with the Fed and how you are thinking about this meeting. And it would seem that consensus expectations are this is the last time we'll hear from Jay Powell before he might start talking more seriously about tapering at Jackson Hole next month.
Right. So I think that what consensus is moving towards a focus on the post-statement press conference. Well, where he obviously will have to acknowledge the rising risks around the Delta variant. And we might get a little bit of talk around taper, but my sense is that the rising risks around the Delta variant, which is going to push down growth forecast, provides the Fed with a little bit more room to delay the inevitable, which is they're going to have to begin to pull back on the pace of asset purchases. I think it's right around pulling back on the pace of mortgage-backed securities, given a very hot housing market. But, it looks to me like the growth's going to work out in the Fed's favor. We're probably going to grow at around 8.5% in the second quarter of the year. A slower pace of reopening here in the second half will push growth into 2022, which will give some, or at least help on the margin around the talk around inflation. But there are some out there who are clearly going to be talking about stagflation. I think that's erroneous, but nevertheless, it's in the market.
Joe, today Goldman Sachs cutting their full-year GDP growth outlook by a little over a percentage point on the heels of Deutsche Bank doing the same. How concerned are you about the COVID Delta variant being a major downside to risk in the second half?
All right, so I reduced my forecast by 0.5% at the turn of the month following the payroll report in early July. We're very concerned. There's an arc of instability from East Georgia all the way through West Texas. I think if you take a look at Florida, Texas, and Missouri, they're accounting for an outside share of the new infections. I think in Florida, 1 in 5 of all Delta infections are in Florida at this point. We are going to grow slower as we don't reopen it at the pace we had foreseen earlier in the year when we thought we would beat our herd immunity by Labor Day. That's clearly not going to happen. Now, I am somewhat encouraged over the past week. We're seeing the political authority, specifically on the right side of the aisle, begin to say, hey, everybody, you got to get vaccinated. That's encouraging. Moreover, I live here in Austin, Texas. We're hearing people talk more openly about, what? Our friends and relatives who haven't been vaccinated, we think they are, and they really need to be. That's another encouraging development here on the ground.
Most definitely, Joe. On the flip side, I wonder how the balance of the economy then is going to shift and find equilibrium between in-person going out economy, travel economy, and the stay-at-home economy. And I say that as well because, of course, we have earnings coming from big tech this week, and we're still expecting them to be robust and put up big numbers. So even if we start to see a little bit of pulling back of reopening, what is that equilibrium for the economy?
Well, I think that it's not an either-or situation, Julie, and it's a great question. I think that, let's just call it the Zoom economy, is now part of corporate America. We're not going back. Yes, the pace of reopening is going to slow. Perhaps as many people won't be returning to the office as we thought after the Labor Day holiday. That may get postponed into later in the fall or early winter. But my sense in terms of the overall equilibrium of the economy, look, we're going to grow probably at 6 to 6.5% this year, right? And that's if the Delta variant really extracts a powerful toll on the economy. That's still well above the 1.8% long-term growth. Now, if you're a trader out there and you're trying to estimate the second derivative equation, right, which is the rate of change of the rate of change, yes, the rate of change is going to be a bit slower than we anticipated. But look, we're still pushing growth out into next year. That will, on the margin, help mitigate things. Moreover, I do think that we will get an assist from a global reopening later next year. That will put us more on a sort of a better composition of growth. Right now, growth in the United States is really about the household in business fixed investment. We really don't have a global component. And of course, the fiscal aid, which has been so generous over the past 2 years, is going to fade going forward. And that's separate and distinct from the infrastructure bill, which we can talk about if you want. But that's really a decade-long spending package, if it passes.
Joe, do you think stocks should be trading where they are? Record valuations last week powering to record highs. As we're all calling for it now, you've marked down your GDP estimates. The other investment banks have as well. Should stocks pull back here?
Well, I think that this is an opportunity for equity markets to take a bit of a breather and assess where things are going. My sense here is that we're still better off if you're looking at investments, thinking about consumer cyclicals, utilities, that sort of thing, to be in a bit of a defensive posture till we get a better sense of what's going to happen, both in terms of growth, Fed policy, and of course, the big debates going on in Washington over a fiscal aid package. That would be the hard infrastructure package, and then the broader piece, which could be as high as 3.5 trillion, as opposed to the 1.2 trillion infrastructure package.
And then, Joe, just coming back to the Fed, we've seen a few reports over the last couple of weeks, questions about who the next Fed chair will be. Will it indeed be Jay Powell? I'm pretty confident no one really knows at this point where that is headed, but this conversation is certainly starting and is not going to get quieter over the coming months. As you think about Powell's tenure, do you think it's best for him to remain? Is continuity best at this point? And how do you think, as a risk to markets, any change at the top of the central bank, how might that play into the equation?
All right, so I think that financial markets would broadly and warmly welcome continuity with Jay Powell at the head of the Fed. I don't really care who you are. If you take a look back what's going on the past 18 months, Jay Powell's performed magnificently, as has the Federal Reserve. I think most of what we're hearing has to do with an itch that has to be scratched out on the progressive left. I think that has more to do with Randall Quarles than Jay Powell. There are going to be 3 seats up for grabs here going forward at the Federal Reserve. The White House is going to get a chance to leave its imprint on the Fed. And I think most importantly, Janet Yellen thinks quite highly of Jay Powell, as I think does the president, and I expect him to be reappointed.
Joe, the fact that you described his performance as magnificent leads me to believe that you don't agree with some economists out there who think that there is a risk of a Fed misstep here, mishandling of whether it's tapering or inflation tapering as it relates to inflation. I take it you don't think that risk is high.
No, I think that's still relatively low. I'm not one of those who thinks that they need to abandon the taxable average inflation targeting regime that was put in place last year. In fact, I think that's the appropriate policy stance, given the broad demographic changes that are going on in the economy, as well as the profound structural changes that have occurred and are occurring in the U.S. economy. Look, if inflation ends up being a bit more sticky, should owner's equivalent rent really begin to firm and then take off, the Fed's in a good position to act. This is not the 1960s or 1970s where they're going to sit there and they're going to do nothing. They can pull back on the pace of asset purchases. They can utilize forward guidance. And if necessary, sometime in 2022 or 2023, create the conditions to begin normalizing policy at the front end of the curve. It's not like they don't know what to do. It's not like the market doesn't know what to do. I think right now these are more talking points around some very interesting but rather unproductive trades that are going on right now. By that, I mean, look at what's happened to those who've shorted the Treasury market since April. It's not gone so well for them.
All right, we'll leave it there. Joe Brusuelas, Chief Economist at RSM. Joe, always great to get some time with you. Thanks for jumping on. I know we'll talk soon.
Joining us now for more on the markets is Matt Mishkin, John Hancock Investment Management Co-Chief Investment Strategist. Matt, good to see you this morning here. One of the themes right now is a lot of folks on the street are in fact cutting their GDP forecasts for the year. Given that, should stocks still be trading at record highs, and what should you be doing with your portfolio?
We do see a decelerating growth environment, and we think that the first quarter was really the peak. The end of the first quarter was really the peak in the economic growth rate. But it doesn't mean that a recession is around the corner. We're still going to be growing at likely mid-single digits here into the third quarter. And then as we get into next year, we think it's more like low single-digit growth environment that we used to have in past cycles. We believe we're in the middle of the cycle. And in terms of investor positioning, we would tilt more into quality stocks as we go into 2022 in the back half here. What we mean by quality is higher return on equity, better margins, stable earnings. Those are the kind of businesses we would gravitate towards as the economy goes into a more normalized growth rate into next year.
Hey, Matt, it's Julie here. So do big tech companies qualify, meet those various criteria you're just talking about? Of course, it's going to be a big week for tech earnings. And I'm curious if you think it's a good idea to own them, in what proportion, and how do you think they're going to do?
So we are overweight, or recommending an overweight to the technology sector. They are absolutely within the quality factor. In fact, it's the largest sector within the quality factor. If you ever want to check it out, it's just the MSCI USA Quality Index is one way to look at it. These companies are throwing off cash. They've got great margins, great balance sheets. And as COVID lingers around, likely longer than we thought just even a couple months ago here, in a COVID world, where we're likely going to not be reopening to the same extent, we're going to be relying heavily on technology. And so earnings estimates this year for the technology sector, for this quarter, are up 20% year over year. The overall S&P is right now tracking about 100% earnings growth. So technology not seeing the booming earnings growth, but a lot of the cyclicals are. But as we go into next year, the cyclical companies are going to have a harder time growing those earnings. And we think tech is going to be better able to grow earnings sequentially from here. And we like that sector going into 2022.
So then, Matt, as you think about, obviously what was a huge rotation into more cyclically oriented areas of the market, value, however you want to kind of slice that pie. We all know the trade that took hold November, really through around March or April. What's the status of that rotation as we've seen tech kind of pick up the slack? Do you think that the cyclical rally can have another leg in the second half of this year, or are these dynamics you're outlining, sort of saying we might be back to the FANG market of the late 2010s?
Yeah, we would trim some of the value side. We still like industrials. Low interest rates, a flattening treasury curve. Industrial companies like the lower borrowing costs. And, you kind of talked about some of them in the aerospace and defense side. You've got machinery, you've got transportation. If we get an infrastructure bill, that can help in industrials. But we would be more selective. If you look at financials, they're going to struggle with a flattening yield curve, low treasury yields. We've got a Fed meeting this week as well. But we think the Fed's not going anywhere because the yield curve is so flat at this juncture. So you've got to be more selective on that value side, the cyclical side. Another sector that's often undercovered on the value side is actually healthcare, which is not cyclical, but it's trading at a 20% discount to the overall market on a forward PE basis. We like healthcare as well on that value side. So healthcare industrials we still like on that side, but we would lean more into quality into the back half, tilt a little bit further away from the cyclicals after such a huge jump in economic growth coming into this year.
Matt, crypto looks like it has hit a short-term bottom. What percentage of your portfolio should be in crypto?
We think that traditional asset classes still provide better risk-adjusted returns. And, I look at, a short-term bottom will be interesting to see. I mean, we were downtrend here June, or really it peaked down in April, May, June. We hit about 29,000 on Bitcoin. I thought that was the break because it was a cliffhanger right around 30,000. Now you're getting this pop, and they had a conference last week about pumping or talking about Bitcoin. To us, what's driving the 10% jump this morning? If you have no idea why something jumps 12% in a morning, and you're searching for clues on that, it's not a great fundamental investment strategy. So we still would look at more traditional asset class. I mean, you talk about some of the fintech. Yeah. In technology, you've got either credit cards, you've got PayPal, you've got other businesses that can have some element to that, and as a growth side engine of it. But otherwise, that's as far as we would take it in terms of adding it to a portfolio.
Matt, sort of on a related note, how are you thinking about the role of the retail investor in this market at this point in terms of their ability to push around not just crypto, but of course smaller stocks, but bigger stocks too, for that matter? Have you changed how you think about the retail investor, how you factor what they're doing into your decisions?
We haven't, but it definitely shows up day to day, and to us, it's just not about getting whipsawed. And if you see like copper this morning is one that is jumping out, and it's hard to see kind of the fundamental thesis as much on some of these, even on the commodity side, that get all of a sudden these big jumps across cross asset. And I think you just have to have that in the back of your mind that, hey, there is a big retail presence now. They are pushing around a lot of capital. There's a lot of liquidity around. And it really, because the Fed's likely to remain super accommodative for some time here, that is something that's going to be there. But we wouldn't overplay it. Make sure the fundamentals support the investment thesis. Watch that, because just as fast as hot money can come into an investment, it can come out just as quick. And so when these things are pushing around, we wouldn't overplay it. Make sure you've got the fundamental thesis intact. And to us right now, the U.S. equity market with the earnings and the fundamentals there, that remains our biggest allocation within a global balanced portfolio and really our highest conviction call.
Got it. Matt Miskin, good to see you. John Hancock Investment Management's Co-Chief Investment Officer. Good to see you, Matt.
All right, a unique Summer Olympics certainly underway over in Tokyo. Sponsors and athletes need to change their approach in order to maximize the opportunity to get exposure at this year's games. Let's talk a little bit now about the opportunities and the challenges. Bring in Jessie Giordano, Senior Vice President over at GMR Marketing. Jessie, thanks so much for jumping on this morning. Let's just start with maybe the challenges that the games face right now from a marketing standpoint. It's a marketing event. I would almost argue first and foremost, we can leave that for another time. But, what are the challenges that the games face with no in-person events and really an event that feels very 2020, even though we've seen a lot change, at least here in the U.S. in 2021?
Yeah, thanks, Myles, and great to be here. I think the challenge really is we've gotten here. So when we look forward, it's just making sure that everything goes off. But when we rewind to the last year, the challenges are across the board, from how the athletes and partners prepare. How do you operationalize the Olympic Games when you can't be on the ground? And then really, how do you maximize engagement with fans when you, again, don't have that human interaction like you usually do?
Jessie, it's Julie here. What about for the athletes? I'm curious in the conversations leading up to the games, particularly for the athletes for whom this might have been their last opportunity, right, to go to a games. So how do they think about sort of the time of their career, the cycle of their career, and how this games fits into it?
Yeah, it's a finite window. We were talking to some of our athlete partners who really were making those life decisions. Do I put my life on hold for another year? Marriage, having children, starting that next chapter of your career. And I think most, because of the preparation that went into it, made the decision of, yes, it's worth waiting that extra year. But then to be able to, compete, and we surely hope that they can see it through.
Jessie, how does this Olympics change how marketers approach marketing for future Olympics?
So at GMR, we always advise our clients to be thinking about it holistically. I think what we've seen is it has to be more purposeful. How are we leveraging that Olympic platform to drive conversation, whether that be diversity, equity, inclusion, sustainability? So much more than just athletic performance. Also, how do we think about experience innovation, shifting from purely physical to having those hybrid, the virtual experiences, content as the driving force? So I think we are seeing it across the sponsorship landscape. It's not unique to the Olympics, but it's definitely making marketers reimagine how they bring those partnership assets to life.
And then just, Jessie, thinking about the Olympics as an institution, there are some challenges around how much you can reference the Olympics and whether it's the big contest in some country X, right? And just some of those practical challenges, how much work goes into making sure that, everyone is in compliance with what end up being, we can say the Olympics in media coverage, but it's a lot different if you're trying to sell something or bring your story out as an athlete or a brand or a partner.
Yeah, absolutely. So we have 7 clients activating during the Olympic and Paralympic Games. Most of them are official partners in some form or fashion. So whether that be TOP, which is the highest level of global partnership, or a domestic partnership partner as well. So we're really advising, how do you take advantage of the full rights and benefits that you have using the IP, being able to reference the marks. But for those non-Olympic partners who are still wanting to show up, it's definitely a very complex undertaking, making sure that you get the credit without using the full rights and benefits packages.
All right, Jessie Giordano, Senior Vice President at GMR Marketing. Jessie, thanks so much for jumping on this morning. Talk a little bit about the Olympics. All right, welcome back to Yahoo Finance Live on this Monday morning. Tesla is set to announce its second quarter financial results after the bell today, kicking off a very busy week for big tech earnings. And joining us now about what to discuss from the electric car maker is Autoblog Editor-In-Chief Greg Migliore. Greg, great to talk with you once again. So let's just start with the fundamentals for Tesla in the second quarter and where the business is at with all of the chip problems, the supply chain challenges that other car makers have been telling us are out there. What has Tesla told us so far about those challenges?
Hey, everybody. Thanks for having me. Tesla stock has been kind of all over the place this year, sort of reflecting the challenges within the company, the auto industry, and the broader economy. Like everything involving Tesla, it's been pretty dramatic, you might say. Shares hit $900 back in January, but they also dropped below $600 at different points. Basically, I think this reflects the challenges that the company is trying to navigate. The chip shortage has hit them, I'd say, moderately hard. General Motors, Ford, and some of the other automakers have actually had to idle factories, whereas Tesla's been able to keep things sort of somewhat on track. I attribute that a little bit to the fact that Tesla is they're a smaller company. There's fewer Teslas to build right now. So they've been sort of able to kind of have a balanced approach and weather the chip shortage a little bit better. We're expecting a solid second quarter. They hit 200,000 deliveries for the first time in Q2. So that's a really solid production figure for them. I believe that's a record. So we're expecting really good financial figures for them as well. So some of those sort of, KPIs that you look for, Tesla's starting to kind of stack them up. So that's a good thing for them.
Greg, just an observation from me. I'm seeing a lot more Teslas on the road by me here in New York City, out on Long Island where I live. And they all seem to be a little beat up, especially the rims. It doesn't look like a $100,000 car in many respects. Certainly, it depends on how people are driving them. But is this company still dealing with quality problems?
Tesla does have some quality issues. They did recently, earlier this year, get a good safety rating recommendation. So that's a good thing for them. They don't have quite they don't have the dealer network that a traditional OEM would have. So there are going to be some challenges with getting your car serviced, getting maintenance. The other thing is Tesla is a very new company. So there hasn't been like a mechanic who's worked on Toyotas or Chevys for decades. So there is some, challenges, if you will. There's a curve here to try to, drive a Tesla for 5-10 years. What's that like? Well, we're sort of figuring that out right now on the fly. But yeah, I mean, to your point, Teslas are becoming very common in a lot of different areas. They have a variety of price points. They're everything from sort of like daily drivers to really trend-setting conversation starters.
Hey, Greg, it's Julie here. Talk to me about China and the demand coming from China, which has been, kind of choppy for Tesla.
So Tesla's, I think, faced several challenges internationally. China is one place. They had some quality issues earlier this year, and that sort of impacted some of their sales. But also in Germany, they moved in there to build another gigafactory, and they're realizing that sort of building something in Germany is a lot more complicated than it is perhaps in the United States. So Tesla's sort of next frontier, if you will, is really international growth, scalable, and profitably. And that's something they're working on. But I think what we're also seeing is that Tesla is having some challenges as a relatively new company. And this is to be expected, too. Just sort of playing in these new markets where, they're the outsider. So I think it's some natural growth pains to be expected.
I also wanted to ask you about some comments. I think that Elon Musk was quoted on maybe last week on the supercharger network, right? That they were talking about opening up that network to non-Tesla vehicles. Do you think we'll get any more commentary on that? Does that do anything sort of financially for Tesla as well, I guess, if they are, charging people money to use those?
It certainly could be a revenue stream for Tesla. They were the first basically to set up the supercharger network. It's still basically considered the best because it's so just uniform. And if you have a Tesla, you know where to go. It could be a revenue driver for Tesla, but we also think they sort of had to do this. With some of the regulations changing, the government is sort of looking for there to be more of an infrastructure, more of a grid, and they want it to be uniform. And this is frankly what most people in the industry want too. To take a very granular example, it's kind of a pain to charge your phone, whether you have an Android or an Apple or a different version of these phones. We don't really want to see the car industry become that way. So we'll see. It could be an opportunity for Tesla to maybe create new experiences. You pull in, it's like a Tesla cafe or something. They could also have a separate spot, like a club for Tesla owners, and then people who have the Chevy Bolt go in a different lane. So I think it really opens up a lot of possibilities. So we'll see how they execute it.
And of course, the question, as a New Jersey resident, will you be able to charge your own Tesla? Because, right now, not pumping your own gas, famously. So we'll see. We'll see how that one shakes out. All right.
Well, if you've ever wanted to invest in art, now is your chance. Masterworks is the first platform where you can buy and sell shares that represent an investment in iconic pieces of art. So let's bring in Scott Lynn. He's the CEO of Masterworks. So Scott, let's just start with how this works exactly. How can someone essentially buy a share of a piece of art?
Sure. So if you take a step back and just look at the size of the art market overall and how it's performed over the past 25 years, contemporary art has appreciated at 14% a year, which basically is beating most other asset classes. The problem has been the only way to allocate to it is if you have millions of dollars to buy a painting. So Masterworks was the first company to go out, purchase a painting, securitize it with the SEC as a public offering, and then sell shares in that painting. So that's the very simple process that we use to take these great works of art and make them into investment vehicles.
Yeah, we chatted last September, I want to say, around kind of this concept and what you've seen in terms of the growth. I'm curious how big it's exploded now, given also that we've seen, the NFT space and digital art also take off. But this is very different from that, seeing as it's an actual physical painting and one that probably has a little bit of a longer track record, given how new NFTs are. What are you seeing in terms of the people who might be interested in Masterworks versus maybe the people who are more interested in the NFT and digital art space?
Yeah, we I would describe our investors as much more traditional, much more data-driven. I think the NFT space is interesting. To us, it still feels very speculative. And I think we've seen that with a lot of NFT prices that have come up and sort of quickly fallen. But, if you look at the art market overall, it's one of the oldest asset classes there is. I like to tell people that Sotheby's is 275 years old, Christie's is 250 years old. So this is literally an asset class that's been around for centuries.
So how long, do you guys hold the artwork for before it perhaps gets sold and investors can really see that return on their investment? And do you guys have any, kind of target return rates that you perhaps have for some of these pieces of art that you are purchasing and then selling shares of?
Yeah, so we don't publish targeted returns, but we do let investors know how paintings have appreciated historically. So just like in other asset classes like real estate, for example, we'll look at comparable paintings that have sold, and then we try to calculate what we call same sale appreciation rates historically. And we publish that to each investor with each offering we do. But generally, these are longer term holds, right? So if someone's investing in a painting, we tell them to think about it as a 7 to 10 year hold. Now, that being said, we did launch secondary markets last year. So we now have investors trading shares in paintings just like they would otherwise trade shares in a company.
Yeah, obviously that improved liquidity is going to be helpful for people who might want to enter and exit some of these positions. But unless there is somewhat of an exiting event or maybe an auction or anything like that, how big do you see those swings in the pricing of these pieces, given, there's not always a lot of events, I suppose, that would change it?
Surprisingly, there's quite a few events. So the thing that people don't realize about the art market is this year, $60 billion in art will sell. Roughly half of that sells through public auction. So with most of the artists that we're collecting, artists like Basquiat, artists like Banksy, artists like Warhol, there's dozens, and even some cases hundreds of sales every single year by those artists to help mark the value of our individual paintings.
So, Scott, I'm curious to know if you do own a piece of the artwork. Could you perhaps then go and view it? Where is the artwork being stored? And then I just have another question about some of the taxes. When you buy a share, that share isn't necessarily taxed when it goes onto the market. But artwork, if you bring it into a state, I know New York State levies, I believe it's about a 4% tax rate on any artwork that is brought into the state. How are you guys handling that? Is that included into some of the sales prices of some of the shares?
Yeah, so I guess to both of those different questions. So we have a gallery now in Soho where investors can come and actually view the paintings. So that's kind of, it's been slower during COVID, but I think we're seeing investors come back to the gallery more to look at the individual works of art, and then we also loan them out to institutions so they can be seen by the public. And then the second question. On taxes, we use a creative structure where we actually purchase the paintings into the state of Delaware. We hold them in the state of Delaware, so there's no sales or use tax. So we really avoid all of those taxes that the collectors would otherwise pay.
And Scott, just going back to one of those points you made on NFTs, we're chatting in the break, no plans to add NFTs. Kind of sounds, I don't want to say a distaste there for NFTs, but it sounds like there's something under the surface there. Why not add NFTs or digital art to the platform? And what's maybe the one warning you'd have for art investors?
Well, look, I mean, we are definitely the anti-NFT people. And I think we come at this really just from a very traditional finance perspective, which is, we think the definition of a strategic asset class is something that beats inflation and is uncorrelated. And I think with NFTs at this point in time, we can't really, say either. It's unclear if they're appreciating, if they're depreciating. We don't know how to think about them as part of a portfolio. I think one of the things that we just struggle with at Masterworks is, the argument behind an NFT is essentially you take a digital image and you put it on blockchain. But the reality is when that digital image is put on blockchain, there's no intellectual property transferring. So, we're just a little bit confused about what people are buying. Like at the end of the day, if I have just as much ownership right in that digital image as the person that owns that token, it doesn't feel like an investment to us.
And before we let you go, Scott, I have to ask you very quickly about something that we see in your background. Is that or is that not an Iron Man mask that you have there? Is that a collectible? We just really need to know what's happening over your shoulder there.
This is my personal art collection, so not anything to do with Masterworks, but it's actually a sculpture by a mid-century American artist called John Chamberlain, who did a lot of these abstract sculptures by using found pieces. Definitely not an Iron Man mask.
Well, I'm far off then. We thought it was Iron Man.
That shows how much we know about the art world. Perhaps Chris and I have a little bit more homework to do here. But Scott Lynn, Masterworks CEO, appreciate you coming back on here to chat with us.
Many businesses, of course, have had a tough year and a half due to COVID-19 lockdowns, but retailers have been especially hard hit. Apparel retailer Express is now looking to capitalize on the return to work as well as drive a lasting turnaround under new management. Express shares have surged nearly 450% this year as retail investors bank on a turnaround for a company they have probably shopped at for the past decade. The CEO of Express is Tim Baxter, and he joins us now. Tim, good to finally speak with you here. So you just passed your 2-year mark as CEO of Express. How is the company different today compared to when you took over?
Well, that's a great question. It's completely different. When I took over in June of 2019, and I had 3 major objectives when I first joined. One was to establish a corporate strategy. The second was to assemble a great leadership team to both inform the strategy and then execute against the strategy. And then finally, to change the momentum of the business, which had been challenging for several years prior to me joining the company. And in January of 2020, about 6 months after I joined, we launched the Expressway Forward strategy, which was our strategy to completely transform the company. And it was based on 4 foundational pillars. I talk a lot about them: putting product first, engaging our existing customers and acquiring new customers, brand, reinvigorating the brand, and finally execution. And we've made incredible progress against each one of those 4 pillars, in spite of the fact that we closed every one of our stores and sent all of our folks to work from home about 6 weeks after launching the strategy.
Who is the Express of today?
You know, the Express of today, we are regaining our relevance. You know, I talked about reinvigorating our brand. And, you know, Express is a 40-year-old brand. And when I started a couple of years ago, I would say that most people would describe Express as a store at the mall, or they thought of us as a store at the mall. And today, we're moving forward on re-energizing our brand. And we want people to think of us, and people have begun to think of us as a brand with purpose. You know, our purpose is to create confidence and inspire self-expression. It's a purpose that resonates incredibly well with our consumers. You know, they want help getting dressed every day. They want help knowing what to wear for certain occasions. And they look to us for that guidance. And that's been an incredibly important part of reinvigorating the brand. And we're seeing incredible metrics on engagement from our consumers as we have shifted all of our marketing towards supporting that brand purpose and completely changed our assortments. You know, Express in the past, we have been well known and very dominant in categories that many people would have considered wear to work categories historically, or occasion-based categories. And the reality is the American consumer has changed dramatically and no longer really thinks about their wardrobe in that way. So we're also a brand that has an incredibly versatile assortment that can dress our customers, both male and female, for virtually any occasion, whether that's shorts and a t-shirt or a black tie event.
You just given that return to work focus for Express, it's always been a hallmark of your brand. What have you seen more recently? We seem to be caught in this gray zone here. A lot of folks going back to work, but now a lot of concern on the COVID-19 Delta variant spreading. What have you seen in your business so far?
Yeah, it's interesting. We have definitely seen a resurgence in what you would call historically wear-to-work categories. We saw an inflection point in our business at Easter when vaccinations were continuing to roll out pretty aggressively throughout the country and restrictions were beginning to lift. And the wear-to-work and occasion-based businesses certainly have had a steady resurgence after that inflection point. I would say, you know, we've seen stronger adoption to occasion-based categories as people have resumed attending weddings. I mean, I think everybody at this point thinks just about everything is an occasion, and they want to get dressed up for that occasion. The wear-to-work categories have had that resurgence, and we continue to see that in spite of what's been happening with the COVID variants and some states going back to certain restrictions. And I expect that will continue based on the data we have as we move into the fall season, particularly post-Labor Day, when we anticipate a very large percentage of the American workforce is going to return to the typical work environment. But I don't think that they're going to return in necessarily the same way that they have. Comfort is going to continue to be incredibly important, even as people return to an office environment.
Tim, it has been a stunning year for your stock. On January 21st, I went back and mined some data off of Yahoo Finance Plus. It opened at $1.16. On January 27th, your stock hit a high of $13.97. What were you thinking while all that was playing out?
Well, I've certainly learned a lot since January, and obviously, there's been tremendous volatility in the stock. You know, our stock had been obviously very negatively impacted by the effects of COVID and having to close all of our stores. And obviously, the profitability of our company in 2020 was very negatively impacted by that. So, you know, we have stayed incredibly focused on, you know, our long-term goal. When I launched the Expressway Forward strategy with our new leadership team, we committed to delivering a mid-single-digit operating margin. And we have stayed focused on that goal. And it is our intent to deliver that to our shareholders both new shareholders who have joined us this year. We've had a tremendous number, obviously, of new shareholders who have joined us this year, and to our shareholders who have been with us for quite some time. And we're on track to achieve that goal. I call 2020 a detour on the expressway forward, but we are on track to achieve that goal, and we stay focused on driving shareholder value. And to me, that is returning this company to a mid-single-digit operating margin.
Tim, is it also your intent, are you looking to raise capital just based on where the stock price is today? I mean, there's been a big focus by Express on improving its balance sheet. From the outside looking in, this would seem like a logical move.
We have, as you probably know, we have an ATM on the shelf, and we have not stated publicly any plan to sell shares. But we do have it from a governance perspective. As we were looking back in late 2020 at different options to raise capital, because at that time we didn't know how long we would be dealing with the effects of COVID-19 and whether or not we would need additional capital. We looked at that as an option, and as a board decided that we should have that at our disposal should we choose to use it or need to use it. But we announced back in January, actually right before our stock spiked, we announced about $140 million in additional financing. And I said at the time that I was confident that that gave us the capital and liquidity that we needed to weather the storm. And obviously our performance has improved very significantly since then. So I'm more confident than ever that we're on track to achieve, our long-term stated goal of that mid-single-digit operating margin, and we have that available to us if it makes sense.
And Tim, before we let you go, today you're announcing a new social customer program. What is that exactly, and how will that impact the business?
Yeah, we're really excited. Today we're announcing a new community commerce program. And, we have a stated goal also of driving $1 billion in e-commerce demand by 2024. And this is an important next step in the evolution of our digital business. So it essentially, it brings together a group of like-minded entrepreneurs that will be called Express Style Editors, and gives these folks the opportunity to build their own storefronts that they can link through all of their social media and engage with their own followers and earn commission on everything that they sell. And we'll be producing exclusive product for these style editors, and they'll also be able to tap into the entire Express assortment. And honestly, you guys were talking earlier about how many people are looking for flexible opportunities to earn money at home and build their own businesses. And we think this is going to be an extraordinary opportunity for individuals who share our passion for creating confidence and inspiring self-expression to create their own storefronts and drive revenue through their communities. So very excited about that and what it's going to mean for us in the future and how we engage with our customers in a very different, new and innovative way.
We'll know quickly, Tim, your shares are up 12% as you're speaking about all this. So clearly the retail investors, they're rooting for your turnaround. Tim Baxter, CEO of Express, good to see you today.
Great. Thank you very much.
Well, after a year of frenzied buying and price gains in the double digits, the red-hot housing market is starting to show some signs of cooling down. We found out today that sales of new homes tumbled to a 14-month low in June. Sales in the prior month came in weaker than initially estimated. It's just the latest sign that expensive lumber and shortages of other building materials are hurting the housing market. Here to talk about it with us and also break down some real estate investment opportunities for us is Alan Swearingen, President and CEO of JLL Income Property Trust. Alan, good to have you here. So I'm just going to ask you straight up, do you think the housing boom is over?
Alexis, I think the housing boom still has great resiliency. By some studies, the U.S. is 6 to 8 million housing units underserved on both the multifamily and the single family sector. So I think what happened in this report that you just talked about is a little bit of summer fatigue. And actually, listen to your interview with a gentleman from Coldwell Banker the other day. I think it's a little bit of buyer's fatigue. It has been such a challenging market for investors that want to own a single family home to buy into it, with pricing going off and, many offers above ask and sales in 3 to 5 days. I think it's just cooling off a little bit, and there's a little bit of summer fatigue and a little bit of buyer's fatigue there.
Alan, is there opportunity if you wanted to look outside of residential to commercial? I was just in Chicago, New York and Chicago, my two favorite cities. Love the architecture there. The empty stores upset me in both cities. And my question, and I think a lot of investors are, is there opportunity here, and when does all of that come back? And whatever happened to Jewel Osco? I didn't see one while I was there.
Well, Adam, there's a lot there to unpack. And I'm speaking to you from Chicago, in my home city. Actually, one of the property sectors that you just alluded to, which is retail, certainly has faced a lot of challenges in the mall and in the high street stores. Again, we're seeing return to work come slowly but surely in Chicago, but a lot of the high street stores have yet to reopen. But one of the retail sectors that has done very, very well, and I know you've reported on some of the grocery stores' earnings, is the neighborhood and community suburban grocery anchored shopping center. And you talked about Jewel Osco. It got acquired and merged, and a new company came in, Mariano's, which is now owned by Roundy's. But the suburban grocery anchored shopping center performed very well throughout the pandemic. Sales were through the roof from grocery stores, and that format, that open air format where people can walk around safely and shop, even in the challenging winter environment of here in Chicago, it still has great resiliency. And it's been something that our fund has been investing in for a while now, and we have high conviction about it. It's the one format of retail that doesn't seem to be losing a lot of sales to online. People still like to go to the grocery store and pick out their fruits and vegetables and meat. And then the service stores that live off that grocery store, the places to get your hair cut, get your nails done, see your chiropractor, get your teeth whitened, see the Doc in the Box, or go to Walgreens or CVS. Those stores are doing very well too. So the service orientation has created that format of retail to be quite resilient from sales going to online, which is the big threat for other brick and mortar retail.
Now, to illustrate that, Alan, I'm in Pennsylvania right now. Within 20 miles of where I am, two very large, well-known supermarkets are about to open up. So we're definitely seeing new business in that area. But I want to shift to office properties, because we know that businesses are desperately trying to get back online and bring workers back into the office, and they're being met with a lot of resistance. Are there still opportunities to be had in the office space?
Alexis, I think you hit on the property type that is probably going to be most challenged in the current environment, and I would say for the next 12 to 24 months. So while there may be opportunities there, it's not a strategy that we're continuing to invest capital in. It's the lowest allocation within our portfolio today, and I think it's going to be the property type that we probably watch and wait and see. The return to work experiment is taking longer than people thought, and public transportation, people need to get comfortable with that again. The Delta variant has certainly knocked that return to work off track a little bit, and so I'm not calling for the death of office buildings, but a property type that we like and we've been adding to our portfolio is in the industrial sector, the warehouse sector, which e-commerce and onshoring and reshoring of jobs in manufacturing has really driven warehouse demand, and the fundamentals of that property type and its performance within our portfolio has been quite extraordinary.
All right, we're going to leave it there. Alan Sorengen of JLL Income Property Trust. Good to see you. Thanks for being with us.